Hi, everyone. I'm Arnaud Ibanez, Merger and Acquisitions Director in Renewable Energy. And I am absolutely pleased tonight to have you for this webinar entitled Crypto Investing in France, Access, Myth, and Practical Pathway. So this webinar will last 1 hour. And I would like to thank CFA France, Alejandro Iniesto, Executive Director, and Sonia Alam, Chief Operating Officer, as well as Bitwise, our sponsor tonight for organizing this webinar. Just bear in mind that tonight, this is just the first event of a series of different events. So you will have many different conferences on webinar, on face-to-face through 2026. So feel free to give us some ideas. You will receive an email maybe by tomorrow just to have the feedback regarding this event and give us insight so that we can organize the best events for you through 2026. So our main goal today is to democratize digital asset world. You know, sometimes it's super complicated and difficult to understand. And we will try, because we have a limited amount of time, to have a strong focus on Bitcoin, so BTC. And we will give you the main tools for you if you want to move forward in this sector. So to achieve these goals, I have the great pleasure to welcome my guest today, Stéphanie Laurent, who is Senior Associate at Bitwise. So thanks again, Stéphanie, for being here today.
Oh, happy to be here. Thank you.
And we will also have Ronald Richter, who is also Regional Director at Bitwise.
Perfect, thank you. Can you hear me okay, Arnaud? Amazing, thank you. I was actually going to start by apologizing to say if this information is known to the majority of you, I am going to start off obviously with just a couple of slides with basic information, but it just seems like maybe it is worth those slides and just taking just a couple of seconds more to go into a bit more detail. Arnaud, I'm just going to rely on you to either speed me up or slow me down. I know that you're going to do that well. But first of all, many thanks for giving us the opportunity to have this exchange. We're really happy to be here. My colleague, Ronald, is sort of backstage. He is there on hand for any questions that we would like maybe a third opinion on, or maybe an alternative view. But for now, I'm going to be just taking us through this presentation. So before I do, I'd just like to provide the usual disclaimer. I'm sure you've heard this before, that this is not in any way an inducement to invest. It's purely educational, and it's just an opportunity to provide a high level or holistic view of the sector. As I said, I appreciate that some of you, maybe not the majority, will have already heard of this. So please don't think I'm insulting your intelligence. It genuinely is just to give sort of a level playing field for everybody. And what we're hoping to do is provide just a basic platform on which you can then go away and build on your knowledge if it's of continued interest to you. So let's start. If you can, oops, apologies. There we go. So the disclaimer, what we're going to talk about today, so obviously access, practical pathways, and conversely to the title, I'm actually going to end on the myths. And the reasons why some of you didn't invest or haven't invested so far is actually quite telling. So we'll definitely address those. So before then, if I'd just like to start by reminding everyone of the current payment framework. Again, I hope you don't think I'm insulting your intelligence, but it's really important to outline these main elements because this is what really differentiates crypto from our traditional payment system. So today, if you think about it, most, if not all payment systems involve a centralized third party. So they're verifying, approving, and then settling payment transactions. We've all heard of SWIFT, BIC for international transactions, etc. So what we do basically call it is a centralized system, so centralization. The traditional banking system is regulated by central banks, by governments. There is always this third party or intermediary that is involved in your payment system. As a result, things can take time for transfers to go through or for transactions to settle. There are also limited banking hours. If it falls on a weekend or a public holiday, then you have to wait. Costs can be high, especially if you're doing international transactions. It can be a real deterrent if sort of 10 or 20 euros out of the 100 that you want to send gets eaten up by that third party. And lastly, one of the most important is dependency. You are entirely dependent on this institution allowing those transactions to go through. Those transactions can be reversed, blocked at the bank's discretion. And also, people in certain parts of the world don't even have access to a bank account, leaving them in quite a precarious position when it comes to those payments. So in general, here we can see we have a sender, we have a receiver, but there's always that bank in the middle. So in essence, we can almost call cryptocurrency a solution. So what is crypto inherently? So it's a currency that only exists digitally, usually only transacting it over the internet. Most importantly, it's not controlled by any government or bank, i.e. it is decentralized, which, as we saw previously, is unlike traditional money. So what we call our fiat currency, that's a word you might hear often. It's essentially our euros, our dollars, our pounds, etc. So the cryptocurrencies we're really looking to solve the issues that we saw in the previous slide. So the high transaction fees, the slow transfers, the limited access for unbanked populations. Another positive on the side of crypto is that it is 24/7 trading. Again, unlike the traditional market trading part of the system.
Maybe, Stephanie, I have one question regarding the ledger that
Yes.
you mentioned. There is a
Yeah.
well-known company in
Yeah.
France called Ledger. Maybe most of the audience is aware about it. Can you just give us a flavor on what they do and what are they so much useful for the ecosystem?
Yes, no, so Ledger, actually a French company, which is great, but probably one of the most well known. So they were launched or they came together, I think, in 2014, so just over 10 or 11 years ago. And essentially what they do is they provide wallets and secure keys for essentially holding those digital assets. So they are a leader in digital asset security. So I think their devices secure, I mean, they're huge. They secure about 30% of all the Bitcoin and stablecoin sort of held by retail investors globally. I think they now I think that they're across 200 countries or something like this. And it's an incredibly interesting company, and people should look them up. They've actually how do you say branched out into other areas, but it's essentially that security that's really important. So you're talking about securing a ledger. It is that network that they are helping to secure. We'll talk about it in a second, actually, because that securing and the validating actually comes with blockchain. So it's actually quite a telling company, an important company in this in the ecosystem. So cryptocurrencies are built on a technology called blockchain. I'm sure everyone has heard of it. Blockchain is a secure online ledger. So in French, we call it a registre, and it's essentially recording and storing all of the transactions. These are represented by lines of data, and the many lines of data form blocks. And these blocks have a maximum amount of data that they can hold. Once that maximum is reached, the block is validated and then added to the previous block. So essentially continuing on that chain. You might also have heard the word mining or miners, and those are the actual validators. So they compete to validate the blocks. And the first ones to validate the blocks actually get the rewards in Bitcoin.
And coming back to Bitcoin, in order to make the link with the rest of the webinar,
Yeah.
can you tell us the number of blocks needed for validating the blockchain of Bitcoin? And is it sufficient to grant a high speed in terms of potential transactions or payment system?
Yes and no, in the sense of, first of all, just in terms of the time it takes or the blocks, we tend to see on average or people say that you should wait for 6 confirmations. So essentially one transaction, if you put it through, if you send or receive Bitcoin, and you'll get one confirmation, that block that you are part of is being validated. And people say that you should wait for 6 confirmations, so the 6 following blocks, to really feel like your transaction is secure and cannot be changed. I think one block can hold about 1 megabyte of data. And in terms of validation, so Bitcoin, and apologies, why I said yes and no is because if you think about it, validation can take around on average 10 minutes. But that also depends on how many miners are competing. If there are less miners competing, it will be faster. If there are more miners competing, it will be slower. You've also got other cryptocurrencies. I know you focused on Bitcoin, but there are others that obviously do this a lot faster. Does that answer the question?
Yep, thanks.
Perfect. Okay. So just in terms of technology, I think people shouldn't be scared of the technology. We've had this around for quite a few decades now. This is really just some history. What we needed, though, was someone to really pull all this technology together to launch what we now call, or what we know as Bitcoin. Well, Bitcoin was launched in 2009, and it really was driven by this desire to create an alternative payment mechanism to the one that we know, that we've used for so long. It was invented by an individual or group of individuals we actually don't know under a pseudonym, Satoshi Nakamoto. And the core idea behind Bitcoin really was that it can serve as an alternative to these government-issued fiat currency, like our dollars or euros, that are under the control of central institutions and inherently inflationary. So this is partly why Bitcoin has a fixed supply of 21 million euros. I think we've mined about 19 or 20 million. There is this hard limit, and we expect it to be reached around the year 2140. And again, this shows really the impetus for the creation of Bitcoin, and really what it drove to be launched. But what is it used for, really? Well, first, I mean, there are quite a few. Bitcoin is obviously the longest, the one that's been most established for that many years. So there are maybe more than just a couple of uses. It is quite simplest in terms of a cryptocurrency. So if you just pick out a couple, store of value, I'm sure you've heard the term digital gold. It is a convenient store of value because the national currency is consistently being impacted by high inflation, and this is not impacted by high inflation. It still actually can be used as a currency, especially for those unbanked populations that we talked about. Not many people in certain areas of the world have access to a bank account, but almost every single person across the globe does have a mobile phone. So whilst Bitcoin is the most famous, there are millions of different cryptocurrencies. Only a small fraction, however, roughly between 16 to 18,000 are actively traded and tracked on major platforms, which means that more than 50% of all cryptocurrencies ever launched are actually considered to be dead or inactive. Despite this large number of cryptocurrencies, the market is really highly concentrated. So Bitcoin and Ethereum together, you will hear of the word, or at least the name Ethereum, they account for nearly 75% of the total cryptocurrency market cap. And the top 20 cryptocurrencies actually make up almost 90% of that market. So this concentration means that whilst millions of tokens exist, only a few dozen actually have substantial trading volumes, liquidity, adoption, etc. So I just wanted to maybe pick out two or three that you'll probably hear, or you maybe will have heard of already. So I just mentioned now Ethereum. Ethereum is incredibly exciting because it is more than just cryptocurrency. I think we have to move away from this idea that it's just Bitcoin and nothing else. Ethereum is a blockchain platform, so it's still decentralized. It allows for developments on the underlying technology, which is consistently evolving. So developers can build and deploy smart contracts, decentralized applications. As I said, unlike Bitcoin, whose technology is relatively simple as a digital currency, Ethereum really serves as almost like this global computing network, which we collectively know as DeFi, so decentralized finance. I think the next one that you'll hear probably a bit about is Solana, who is a real competitor to Ethereum. In the same way, it's an open source blockchain, so it's really used for decentralized applications in the same way. The difference is that it is faster and it is also cheaper. So it supports thousands of transactions per second. I know, Arnaud, we talked about at the beginning with Bitcoin, but regarding Solana, regarding Ethereum, competitively, Solana is more scalable. It's lower cost to Ethereum, but it's actually better for the smaller retail transactions. With the smaller transactions, it can actually do it quite quickly. Ethereum might be better for the larger volume or the larger transactions. Next is stablecoins. This is something that everybody is going to hear about, at least in the next 12 months, if you haven't heard of it already. So stablecoins are a type of crypto that's really designed to maintain constant value by being pegged to a real world, a fiat currency. So typically the US dollar. That's probably the most well known, it's the most popular. So the issuer will have to hold $1 in reserve for every dollar pegged crypto token that it creates. I think what's really, I won't say special, but why everyone is talking about it now is because it allows people to move money across borders without interacting with the banking system. And issuers really push the fact that this can be a true lifeline for people in countries without any developed payment system. Stablecoins really are going to be something that we're hearing about going forward a lot. And then tokenization. In general, tokenization is really the process of issuing a digital, unique, but definitely anonymous representation of a real world asset. And the real world assets can be anything. It can be real estate, it can be a piece of art, it can also be a financial instrument, such as bonds. They allow for fractional ownership. You don't have to have the entire thing. It allows for increased liquidity and again, 24/7 trading. So here for regulation adoption, I actually won't spend too much time on this because there's a lot of information on this slide. It is quite dense. But just to give a bit of a recap, because I think this is important just to position yourselves if you are interested in potentially owning or investing in crypto. The first, obviously, on a European scale, we are lucky enough to have MiCA. So MiCA regulation is one of the first, if not the first, global regulatory framework in the world for crypto activity. So obviously the objective is to standardize, to regulate crypto across all the EU member states. It was adopted in June 2023 and came into force in December 2024. If we focus on France, because this might be of interest to most of you, importantly, crypto digital assets can be legally bought and sold in France. They're classed as actifs numériques under French law. And in terms of how you can invest, there are probably two main ways for now. I have put three, but there is a reason. The first, green tick, very easy, is via a standard securities account. So the equivalent of our compte titre. You can access this directly on a platform. You can ask if you've got a CGP or an advisor. You can ask them, and it's completely open. You can invest in crypto ETPs. I have put ETPs here. I'll explain what they are in the next slide, but they're almost exactly like an ETF. So it is a vehicle that you can get exposure to crypto through. The second is contrat d'assurance vie. So I put this as a black tick because in theory, it is possible, but it remains incredibly complicated to do. So for this reason, because of the complications, there are so many criteria that you need to be able to fulfill, and even just maybe lower risk appetite for people that issue these, many actually don't offer this. So you can, in theory, you can ask whoever your provider is or your contractor is, you can ask for it to be done, but the likelihood now is that they do say no. What could be interesting is for those perhaps lucky enough to maybe look into the Assurance Vie Luxembourgeoise. This is a category D sort of wrapper slash vehicle or investment type that you can look at. So I think if you fulfill those conditions to be categorized as category D, I think those who will know what I'm talking about. This is actually possible for you. The last is the PUA, so the stock savings plan. I've put this as a red tick because as things stand today, you are not able to get exposure to crypto or invest in crypto through your PUA. However, this is due to change. We still don't have a timeline on when, but I've put this on here as a red tick because today you can't, but we're actually looking for this to be changed in the next or the coming however many weeks, months, etc. So it is on the regulator's radar to be improved or to provide access. I won't go through the last box. It's just to give you a bit of a flavor as to the institutional adoption. We have sovereign wealth funds, endowment plans, governments as well looking to cryptocurrency. So the institutional nature of this asset class is really evolving, and that really is an incredible thing to see and does impact a lot on sort of the market share, the price, the dynamics. And it's incredibly important for us in financial services to see that this happens. So next slide, essentially, how do we access it? So we can probably summarize access in three main ways. I think the first is pretty obvious. It's direct. So essentially, you can open your own wallet. You, of course, are in total control. You're the ones making the decisions. The downside is that all of the risk and the responsibility will also fall on you. And in spite of this being, especially with things like Bitcoin, it's been around for maybe 10 to 12 or just under 20 years. The asset is still in a pretty new sector. It is quite confusing to be able to navigate if you don't have that much experience. We hear all of these horror stories of people who are being locked out of their wallets or forgetting their passwords, and they've got a huge amount of money that they just cannot access. The second would be your typical maybe hedge fund structure. So, okay, in this occasion, you are passing the risk on to someone else. They are managing your funds. However, those type of structures can also be a bit opaque. They lack transparency. The liquidity also tends to be quite low. I mean, it's very rare for these to have daily trading, and also transaction fees. The cost of actually investing in these types of structures can be quite high. So the third way, and probably one that we prefer and that we focus, especially as a company, but maybe for this presentation, I'll go into a bit more detail as well, is an ETP, so an exchange traded product. This is the most well-known type of ETP to many in the webinar will probably be ETFs, which are exchange traded funds. They trade like shares on stock exchanges. However, for regulatory reasons, we have to rule out the use of ETFs for crypto. Under UCITS rules, ETFs in Europe are not allowed to hold only one underlying asset. And whilst there are thousands of different cryptocurrencies, they are considered to be one asset type.
And
So ETFs
this is key, yes, what we are seeing, Stephanie. Due to regulation, you can buy ETF related to one just cryptocurrency. That's why this is not proposed on the market so far. This is a key point on European regulation.
Exactly. So if you do see, because a lot of people maybe interchange, but if you do see a crypto ETF, it is very likely it is US domiciled. So just to remember that. But ETPs work in almost exactly the same way. So because ETFs are not accessible, the industry essentially had to position itself on another type of ETP, and we had to go down the same route as gold. So you will see that there are gold ETPs. And in this case, we've gone down the ETN, so exchange traded note channel. So exchange traded commodities that we see, which is part of the ETN bucket, they work, as I said, in almost exactly the same way as an ETF. But in this case, the ETC is fully backed by the underlying asset. A certificate is issued as proof of your ownership, and it is this that can be traded. So if it sounds a bit confusing, we'll just look at a chart at the moment. I'll just go through almost like a bit of a case study.
Yeah, and time is running fast, Stephanie, so we can move quite fast on the next two slides so that we can focus on Bitcoin as well. Yeah.
Yeah, of course. So an investor puts in a purchase order, the order is transferred to the relevant market maker, and then they purchase the requested crypto. The certificate from the issuer is generated and sent to the investor. So the important factor here and why ETPs are the best way to access crypto is that the risk is taken on by the issuer and also mitigated by the issuer. So the underlying assets in the case of an ETP don't belong to the issuer. An SPV is created, so a special purpose vehicle, which is a separate legal entity, and it's created to really isolate financial risk. So the SPV is managed by a fiduciary. All accounts are segregated, so there is no cross-contamination. So I'll try and just move through this quite quickly, but what we've prioritized is really to have an operational and legal setup that reflects what the most institutional of investors would expect to see from their own investment managers in traditional finance. An independent administrator is appointed, so that provides an additional level of security. A multi-custody process is also adopted, and the custodians are also covered by insurance. So should anything, all of this is to say that should anything happen to the issuer, then the clients, the assets, the crypto, they are all protected. I'll just move on. So the platforms, you can have a look at the different platforms, the ones in France. So probably this one, in terms of Bitcoin, to be honest, we had a chart that went from June 2015 to June 2025, which looked slightly different at the end. But essentially what we can see is that whilst there have been dips, the overall trend has been upwards. So for 11 out of the last 15 years, it has been one of the leaders. There have been big corrections, but it has been one of the best performing assets of the decade. Over time, we see that macro shifts such as inflation trends, central bank policies, speculation, as well as increasing adoption and growing interest have driven a lot of these swings. What we notice is that often what follows these dips are 2 to 3 years where Bitcoin reaches new all-time highs. So
And
this again,
one question, Stephanie, regarding this
yeah.
shape. This is super interesting because, as you can see, this shape is just growing a lot since 10 years. And we can see a kind of tendency that is breaking, which is quite recent. So could you maybe give us some insights regarding why we had such a poor performance since 2025 compared to gold or even US equities as well?
Yeah, sure. So I have to admit that the final quarter of last year was quite difficult, and it really was marked by the largest deleveraging event in digital asset history. But for us, to be honest, it's not necessarily the reasons behind the drop that are concerning, because for us, it's just following the usual cycle that we've seen in the past decade. And what I mean by that is Bitcoin's 2025 price drop was primarily due to a traditional 4-year, what you will hear is a 4-year cycle, boom bust cycle, where the all-time high price led to a lot of profit taking by those who were holding on to Bitcoin for a long time. So our CIO, Matt Hogan, actually puts forward the argument that this started to happen as early as January 2025, but was slightly hidden by temporary and heavy ETF inflows. So the institutional money that started coming into the ETFs through 2025 actually masked an earlier sort of sell-off that had already started to happen. So in October, just to summarize, we saw long-term holder sell-off, so those early investors taking profit. A lot of leverage was flushed out of the system. There was rotation to other assets, actually. So investors that shifted that capital away from crypto into other high-performing sectors like gold. So you mentioned gold. Even the central banks, I mean, they've been buying up gold for the past 2 to 3 years, and that continued through last year. What didn't help also were these macro headwinds. So factors such as fear surrounding Fed leadership changes, all these statements coming out about tariffs, and also even regulation. There was some crypto regulation that was delayed, which really didn't help.
And maybe one remark on my side, and this is absolutely not an investment advice, but if this is super important on the entry point in terms of valuation. So those following the momentum super late might have incurred some losses if you went late in 2025. So for almost all investment, and I think this is true for Bitcoin and the cryptocurrencies, it's sometimes interesting to split your investment within some months or some years in order to have an average. So it means you will never be on the top performers, but of course you will never be on the worst performers. So you will have a kind of average performance, and it could, I want to be prudent, but it could protect you against potential dramatic downsides, even for highly volatile cryptocurrency. So bear in mind, sometimes following the momentum could be super risky, including in cryptocurrency as well.
No, absolutely. Thank you. Are we okay for time? Great. So actually, that's really good segue into the next slide, if that's okay. Because if we look from a more of an investment management perspective, in terms of allocating into a portfolio, allocating crypto in a portfolio, again, we're staying on Bitcoin. But this is really interesting. And I mean, we love a chart at Bitwise, and this is a really important one. If we take a traditional 60-40 portfolio, obviously 60 in equity, 40 in the bonds bucket, and we allocate even just 1% or 2.5% or 5% and so on to Bitcoin, if that had been done over the last decade, or just over 10 years, sorry, just looking at the range, the returns would have been absolutely transformative. So if we look at them, the annualized returns have increased along with allocation, which is what we expect, although volatility has also increased. Again, something that we have expected. But the differences between those different percentage allocations are really not that high. So the Sharpe ratio is increasing, which again is positive, but even the maximum drawdown hasn't actually gone up by that much. So when you look at the returns that could have been generated, had you allocated even just 1% to this traditional portfolio, you're actually missing out by not having this in your portfolio. And just to your point before, Alno, about the volatility or even the risk, this is a real diversification tool. And hopefully these returns, again, it's not an inducement to invest, but it's just incredible to see that in the past 10 or 11 years, even just 1%, we haven't calculated 0.5%, but even just 1% of that additional diversifier has made quite a big difference. You can even go one step further. You can even do a portfolio just of crypto and then diversify through those. But for now, we'll just keep to a traditional portfolio allocation and Bitcoin. We have to stress that there is no free lunch. These returns come with higher volatility. It's still a risk asset that I think everyone can accept. And historically, crypto has been more volatile than the other asset classes, and this risk factor is factored into our analysis. However, having said that, we are noticing that as with other asset classes, as it matures, becomes more institutional in nature, volatility is actually decreasing over time. If we look at the graph on the right, we can see that during quite important global shocks, I think the most recent one or the most obvious is COVID, Bitcoin's volatility was actually not higher than other securities that you might see, such as Nvidia. And this 4-year cycle that we touched on before, that was reflected in the earlier performance slide, is actually said to be on the way to being pushed out to even 4.5 or even 5 years going forward. Again, just another couple of charts showing how volatility has gone down. This chart on the left is over a longer time period, talking about realized volatility, and the one on the right shows Mag 7 versus Bitcoin, obviously referring to volatility swings with the 7 dominant US tech stocks. But I'll leave you to have a closer look at that. I'll let you take this one away because the next one is one I want to focus on, but actually coming on to something which you mentioned, Alnor, which is gold, correlation with gold, how it's reacting, the price dynamics, how they react to each other, which is super interesting. Here we go. So Bitcoin has earned the title of digital gold for many reasons, and investors and analysts often use this term because Bitcoin's perceived value, scarcity, status, and store of value is quite like what we would attribute to gold. So again, limited supply, decentralized in nature, serves as a hedge against inflation. Volatility for Bitcoin is still a concern, but as we said, this is decreasing and will stabilize in the long run. However, what is quite interesting is that correlation remains low. And Arnaud, you mentioned what had happened recently in the last few months. So we're just going to sort of go a bit further back, but talk about it. So gold and Bitcoin, or crypto, but let's stick on Bitcoin, are viewed as very different investments, which is why they've performed differently. So the digital gold narrative has turned out to be a bit empty in some cases. So gold performed very well at the start of the year that you mentioned, Alno, with Bitcoin underperforming. We all recall the precious metals kind of buzz. Gold, silver, they tend to be the first movers in a reinflation cycle as economic growth kind of kickstarts again, and as inflation fears also rise. people tended to be quite disappointed that Bitcoin didn't behave as they expected it to. Retail money, however, had already pivoted to other asset classes, such as equities, precious metals. And as I mentioned before, even the central banks continued to buy gold. As such, Bitcoin was not necessarily viewed in the same camp as digital gold, and this is reflected in the correlation chart. More recently, gold and the other precious metals corrected, whilst Bitcoin actually held firm. That's the difference in price most recently. And this is quite interesting to note because it suggests that most of the price pain has already been digested. So correlation is still remaining low. So even more recently, so that was maybe the end of last year, beginning of this year. And we're talking about the correlation, obviously, which looks at a linear relationship between two assets. And here I completely appreciate we're just looking at a 60-day window. We're only considering the last 2 months of the data points of both assets. Just to address Ethereum, please ignore that for now. Ethereum doesn't have a finite supply. It's just moving in an extremely correlated way to Bitcoin right now. But Bitcoin is, again, the by far the dominant market force. So please don't worry too much about that. But for Bitcoin and gold, a correlation of 0 doesn't actually mean that they move oppositely, but just that at this moment there is no consistent pattern. So for the past couple of months, there have been a lot of noise, many factors that we know about that can affect this. Bitcoin actually crashed much earlier than gold that we saw last year, at the end of last year, and has remained quite flat. Gold has only started repricing now. So there, in terms of volatility, there's already a bit of a mismatch. We have to also accept the fact that gold is a much larger asset. It's up multiple 3 over the year. Investors and central banks are taking profits on it to get USD liquidity as those financial conditions are tightening. Bitcoin just can't play that role right now. It's already crashed. It's almost done its duty. So most people really are not in profit if you bought recently, to your point, Elno. So investor dynamics are also very different now. So really just to summarize, the current tightening of financial conditions, the war, their relative performances over the last 6 months, they've actually been quite different to what people expected. So they're creating two different volatility profiles. And that's knocked them out of sync. And this can happen actually for two assets that would react or have those knee-jerk sort of short-term reactions in quite a small period. So ultimately, while 60 days is short, there's still a lot of noise. They are indeed not the same asset, although they do share similarities. Their volatility profiles are different, as I mentioned. Their market caps and sizing is also different. And their recent performances as a result have been different as well.
Thank you, Stephanie. Now I think we can go to the meet. We are just 15 minutes left before the end of the call. Maybe let's begin with a question we've received previously from Murad on Bitcoin. On his side and on his view, he thinks that BTC could be a bubble that is about to burst. So how could we give some argument against this fear and myth?
Look, I mean, personally, I don't think BTC is a bubble that is about to burst. There have been corrections, they've been huge dips before, and Bitcoin has come through all of them. So apologies for being a bit romantic about it, but it does have the longest track record of all the cryptocurrencies. It's got the largest market cap within crypto. Even the Bitcoin ETF is the largest of all the crypto ETFs. It shows investor conviction. It's slightly different. What I would say is that whilst the dips or the corrections may look the same, in that people were expecting this after a 4-year cycle, the types of investors or the money is different because of the institutionalization of it. If you look at the adoption by the largest institutions, you've got the sovereign wealth funds, the endowment plans that we saw on the earlier slides, but also the regulation. I mean, these larger institutions, these governments are putting in place, are setting the tone. They really know that this is coming and it is inevitable. So whilst I know you picked on Bitcoin maybe specifically, but I think the entire ecosystem is really institutionalizing, and that means that it's not going away. It's not going away anytime soon.
All right, so please move forward to the other myth, including also ESG topics to be covered. They are important because, of course, cryptocurrencies have been accused of being poor in terms of ESG, and I think you have some arguments interesting to share.
No, absolutely. I'm going to be very honest. If we can't bust the myth, then we won't. But there are obviously sort of arguments that we can say. So first of all, it's not compatible with ESG considerations. I think the one that everybody talks about is the fact that it consumes a huge amount of energy. What I would say is that the first time people were talking about this really relates to Bitcoin because Bitcoin runs on what we call a proof of work protocol. So essentially, proof of work is a decentralized consensus mechanism used in blockchain networks like Bitcoin to validate transactions and create new blocks. And it's done by a network of miners. So it's essentially computational power. It's just huge computers, and they do use up an incredibly high amount of energy. However, what I would say is that on the one hand, okay, yes, we agree, it does use a lot of power, but these make actually high barriers to entry, which make it more secure. So some actually could say that it's worth it. Secondly, we've got a growing number of cryptocurrencies, for example, Ethereum, that run on a proof of stake protocol. So energy consumption is actually massively reduced because validating isn't using up, it's not looking to computational power, it's actually looking to staking. And what is staking? Just a quick sentence. It's essentially lending your tokens, your Ethereum, as collateral, and it is that which is going to be the validator. And you are actually earning rewards on the Ethereum or the tokens that you have staked. So completely different. And lastly, even if we are talking about Bitcoin and the proof of work protocol, energy consumption is a lot more efficient than previously. There are a lot of people that are looking to renewable energy sources, wind farms, etc., to really bring their consumption of energy down. So they are looking to reduce that massively. And I know that from the survey, this actually came up. But I was going to say one of the myths is that it's really a smokescreen or a front for any crime or criminal activity. To be honest, there is, I mean, again, illicit activity. Yes, there is illicit activity, and 2025 did see a record 154 billion in illicit volumes, which was up from the previous year. However, we really need to put this into perspective. It is less than 1% of the total crypto transaction volume. It really, I mean, I'm putting this down just to illustrate it, but we really would like to just stress the fact that it's not even 1%. And you can sort of go to extra lengths to safeguard anything. Second one, it's just a phase.
And just before moving to this
Yeah.
second myth, for the audience, do not hesitate to write some questions on the Q&A part of Zoom. We will answer in the remaining time. So Stephanie, we just have 10 to 15 minutes maximum left, and we will need at least a couple of minutes to answer the questions we've just received. So let's take 5 minutes, no more, for the next couple of minutes.
Yeah. Yeah, don't worry. So basically, it's a phase. We talked about it, global adoption, with everything that's going on. Governments are regulating, institutions are allocating, individuals are owning. As at March 2026, we've got a total crypto market cap of 2.5 trillion, which, if you think about it, less than 20 years ago was probably closer to zero, which is an incredible scale up. And then European crypto adoption, really driven by younger generations. 52% of millennials, 48% of Gen Z owned crypto during 2025. And here we've just put some of the growth rate. we've seen these fundamental changes, not only in the institutional space, but also in Bitcoin and how it is affected. So I think all of these different things, and as I replied to the question before, price dynamics are now also shaped by institutional scale flows rather than just those retail cycles. And then the last technology, just the fact that you can have a look, but essentially what I mentioned about Ethereum, it's just beyond just a peer-to-peer payment system now. It's the underlying technology that is really developing that is incredibly exciting. And this last one, so crypto has no value. Well, it doesn't generate any profits. I can't touch it. How is it worth anything? Well, I'm going to do something a bit sort of, we'll say sneaky, but I am going to take what our CIO, Matt Hogan, has said because I thought this was an incredible analogy. He explained it best when he said, Bitcoin should be looked upon like a service. So come at it from a different angle. Don't come at it from a cryptocurrency. Come at Bitcoin as a service. The service Bitcoin provides is the ability to store wealth in a digital format without relying on a government or a bank. He gave the example of Microsoft, which is a good one. Microsoft provides a service, the ability to edit documents, manipulate spreadsheets, etc. And Microsoft service is accessed by subscribing. You pay Microsoft X amount, and then profits flow through to Microsoft's bottom line. So the value of Microsoft stock is tied to how many people want that service, and Bitcoin is similar. The more people who want Bitcoin service, the more valuable it becomes. So Bitcoin's price up over the last 10 years is just showing that more and more people want this ability to store digital wealth in a way that isn't intermediated by a company or a government. You can also look at fundamentals. They do exist. You can consider a lot of different economic, financial, and even blockchain-related factors. Project indicators, for example, they provide qualitative insights. You can look at the team, the developers, white paper analysis, tokenomics, etc. And then from a financial perspective, you can look at some quantitative insights, including market cap, liquidity, trading volumes, and token circulation supply. And I will probably end on this, which might be familiar to some of you, which is actually the CFA sort of guide to valuation of crypto assets. So it was drafted by a couple of members of the CFA Society. Definitely worth a read for anyone who's questioning how really we can value this asset class. Just adding a chart on trading value. Here, again, just from a compliance perspective, what are the risks? And then at the end, you're more than welcome to take the presentation. And we've got some slides on Bitwise as a company at the back of the presentation. So thank you.
Great. Many thanks, Stephanie, for this insightful discussion. We had Ronald just join us. Thanks a lot, Ronald, for being with us tonight. We just have less than 10 minutes for the Q&A. We've received a couple of questions on Zoom. First, a quite interesting and technical one shared by Adrien Olanier regarding how can a professional leverage blockchain to trade stocks while reducing some costs like custody costs and operational constraints. Do you have so far business case for blockchain helping trading some stocks so far with efficiency on fees and also on some potential constraints?
Not yet. Can I answer this one, Stephanie? You're fine?
Please.
Yeah. Okay. Hi, everyone. Thank you, Stephanie, for this presentation. In a nutshell, as we speak today, the cases, and this is about tokenization, there are some live cases, for instance, where funds or fixed income obligations, I can have an example, for instance, the city of Lugano has tokenized and issued 3 rounds of their own bonds, of the city bonds in Switzerland. And those bonds, you can trade them 24/7 in Switzerland. And there are other examples, like, for instance, Apollo and BlackRock and UBS have tokenized money market funds. I think we are not at the stage yet where equities have been tokenized at a large scale. But this will happen in the future, and obviously the advantages of this will be that you have access 24/7 to trading. Liquidity will be obviously dependent on who is trading, but this will obviously, blockchain will help to make, like it does for stable coins today, to lower the costs of transactions, and then to do those transactions quite rapidly and at any time of the day.
Thanks, Ronald. Second question we have for you from the audience on digital asset treasury companies. Can you just give us a few insights regarding maybe the most well-known strategy, what they did well, and what happened to them recently?
So it was a bit fashionable to launch your own digital asset treasury company last year. I think that the attention was taken away from altcoins to digital assets treasuries last year because those were the ones that were performing the best. And everybody jumped a bit on the bandwagon and launched as I said, their own company because they saw the share prices of the other companies like Strategy, for instance, or MetaPlanet go very high, and obviously that attracted a lot of people, but very late in the process. So I would say the early players there have a big advantage because they have started doing this process a long time ago. And for instance, Strategy several years, MetaPlanet also. It's a question of size. There will be consolidation, and I think those, as mentioned, who have started investing and creating a treasury last year are currently suffering a lot and probably won't make it in the long term to be able to refinance and obviously issue new ways to buy Bitcoin over the long term. So we will stay focused on the bigger ones who have the ability to continue buying. And this is Strategy, MetaPlanet. We have a French company, Capital B, who is doing a good work. And I think just to finish, so I don't want to talk too long. I think there is now an evolution about those treasury companies. They are all looking now to not only keep Bitcoin and build a position in Bitcoin and holding a long-term holding, but also to give yield on that Bitcoin. And this is the evolution of these digital assets companies.
All clear. Thanks a lot. And last question for today, since time is running out. We have a question regarding the regulation in France. Sometimes in Europe, we have very strict regulations compared to the US or compared to Middle East. Do you think that regulation is good for crypto assets, digital currencies? Are they helping the ecosystem to develop? And maybe what could we see in the coming months or coming years as new regulations helping the ecosystem as well?
I don't think we have everything now. We have MiCA in Europe, so this is a good foundation for this regulation. You will see different now an evolution of that law and different versions. We will upgrade it and make it better. And this is already in the works. So there will be a kind of a mise à jour of this regulation, of the MiCA regulation. And secondly, what happened recently, and Stephanie mentioned it also, it's now in France, specifically in France, the IMF has included in its distribution law to retail investors the concept of the ETP. Which was not prior to December 2025, really clarified in the text. So now retail can access via ETPs, and banks can sell ETPs to retail investors if they respect a few criteria, obviously. And I will let people read the criteria. We'll go into a regulatory discussion. But yes, and also to answer your question, Arnaud, regulation is necessary. If you want adoption by institutional and retail investors that need to be protected, you need a framework that is solid around it, and you need to take. We are getting. If this needs to become an adult, we need to get out of this youth state where there are no rules and it's open, kind of open range. This needs to change, and it is changing, and it is for the good. It just needs to be done also to keep also the characteristic of the advantages of the technology. And that's why we have today a discussion in the US about the Clarity Act, where there is a fight between banks and the crypto industry on how to treat stablecoins and the yield of stablecoins. So we need to find that balance between the two, but definitely the institutionalization of the asset class goes through regulation also.
Yeah, so many things to come later. So great news. And of course, we will keep an eye on this. Thanks to both of you. This is the end of this webinar. Tonight, we almost finished on time, which is good. Sorry for the audience. We received a lot of questions, but don't forget, you will have plenty of different events through 2026. Don't forget, there is the stablecoin event organized by CFA Société France on April the 9th, so coming in a few days. And then please answer the emails that you will receive by tomorrow normally, and feel free to propose some insights and topics you would like to be covered this year. We will customize the next event just for you in order to answer most of the questions you could have. So thanks again to all of you. Thanks, Sonia, for organizing this session. And see you soon.